dive right into my main focus point, which is going to focus on housing, something that I think is applicable to a lot of people, whether or not you own a house or trying to sell a house or you're trying to buy a home. And that's because for a while, home sales have been dragging, be it because supply is a little bit low or because mortgage rates have been rather high. And now some people are issuing a warning that housing will soon become a major drag on the economy. Now, the main culprit is likely going to be interest rates. High mortgage rates, roughly around 7%, are dampening home sales, but also construction and pricing. Even if you have supply increases, if you're a business that builds homes, but people aren't willing to give up their 2%, 3%, 4% mortgages for a new 7% one, you're not really incentivized to bring in new supply. Just as an example, if you're looking to buy a $425,000 home with a 10% down payment, your monthly cost is about $2,900 a month. That's the power of what happens when interest rates are higher. It can send those monthly payments to unaffordable levels. And so it's understandable that those people who have lower rates, who don't need to move, aren't moving. And so while at the same time, people aren't building as many homes, if people aren't selling as many homes, I think anybody can realize that that means the availability, the housing supply is therefore limited. And you see that, again, from the building side as well. You're seeing delayed land purchases. You're seeing abandoning costly incentives like rate buy downs that some of these buyers have tried to do to incentivize housing purchases. Goldman Sachs slashed its forecast, now predicting that 50 basis point home price growth in 2025 and a 1.2% in 2026. Certainly far different from what we've seen in the first half of the 2020s. Before they changed that, right, just a month ago, rather than the 50 basis point growth that they're now projecting in 2025, the number was 3.2%. That's a significant downward revision. And it's not all about housing increases, right? You're also seeing some areas like Sunbelt cities, your Miami, Orlando, Nashville, Dallas, expected to see maybe 5% price decreases through 2026. The thing about housing, the thing about real estate that you have to understand, right, is you do have national trends, right? Mortgage rates are national trends, okay? But you also have local trends. And so you have markets that overbuild housing, putting a lot of downward pressure on prices. And you may think to yourself, okay, downward pressure on prices, this can be good for me. But from an overall economic perspective, not really great. Think of the analogous area of oil, right? We talked about it before. When oil prices were falling significantly, what did that mean for oil wells? The construction of new oil wells, digging those oil wells, utilizing those oil, or rather drilling those oil wells, opening those wells. Well, those oil companies, the price was too low, didn't do those things. That hurts supply down the road. It is a self-reinforcing issue. Same thing with housing. If prices are lower, yet input and building costs remain where they are, well, if I'm a home builder, I'm not going to fix this problem. And that impacts year over year over year. It compounds year over year over year. And so unless mortgage rates fall materially, which given the level of deficits we are likely to see over the next decade, making it rather unlikely that we see significant downward pressure regardless of if the Fed starts to cut rates, Goldman and many others expect a broader housing-led economic slowdown that could impact us for years to come.